Welcome to Financial Launchpad, a podcast designed to teach you about personal finance by starting with the basics and progressing to more complicated topics. We'll tackle a new topic every week and provide additional resources to learn even more and action items to launch your personal finance journey. I'm your host, Emily, and thank you for joining me as I discuss the topic of asset allocation. Now, I want to start this off by saying that this podcast will actually have a few visual components. So obviously it's on YouTube, and generally there's nothing visual to look at, but this will have a couple of graphs as well as really the rest of the investing series. I plan on having a few visuals just because it's a lot easier to explain some of these concepts by looking at a picture or a chart than me just saying it in words. So today I'm going to talk about asset allocation, which is essentially how you balance what money you put into stocks, bonds, and cash or other safe locations when you have a savings goal, essentially, is where you're putting that money. There are some other options aside from stocks, bonds, and cash, like savings accounts, that I won't focus on. Just an FYI, I know that there are others out there, but these are the main ones. And really, with an asset allocation and what you're really going for is balancing risk versus reward. You know, that's how it is for everything, for all of your savings goals. Trying to figure out how much risk you can have in order to get the biggest reward. So stocks are generally some of the most risky ones. And just a very brief overview, I'm not going to necessarily get into what is a stock, what is a bond. I will link to some of those videos that explain it a little bit more. But stocks generally are a little bit more on the risky side. And basically it's when a company sells shares, so you own a part of that company. And, you know, what you own with the stock, that'll go up and down based on that company's stock price. And bonds are basically loaning money to government or corporate entities for a fixed rate and time horizon. So that's what both of these things are individually. And when I'm talking about stocks and bonds in this episode, I'm not talking about individual stocks and individual bonds. You know, that's how I'm going to be referencing them. But really, I mean stock mutual funds and bond mutual funds, which is a pre-made collection of various stocks or various bonds. So I'm not advocating for just buying a single stock. In fact, I think that that's basically an awful idea when it comes to your savings goals. So what I'm talking about is mutual funds, groups of stocks, groups of bonds. We'll get into the funds later that I prefer and we'll be talking about. So your asset allocation affects your rate of return, and it's really important for your savings goals. And how you allocate these assets depends on your personal risk tolerance, what your goals are, and really, I think most importantly, what that investing horizon is, what that time horizon is. And just backing up a little bit, the big picture of this is that you have savings goals for your money. That could be saving up for a wedding, a house down payment, kids' college, and especially retirement. And as Jesse says in the YNAB podcast that I'm linking to, there are three main components to your investments and saving: the amount that you're putting in, the time that it has to grow, and the rate of return that you're going to get. And the time period for your goals dictates how much you need to rely on saving versus how much you can count on rate of return. So for most short-term goals, this is a little bit simpler. You know, we already talked about those savings and emergency funds and talking about keeping them out of the stock market, out of the bond market even, and keeping them more in cash accounts. Just because we know that what we're putting in will be the main component of what we have at the end for those savings goals. You know, for those short-term savings, what you're putting in each month really dictates what you have at the end. And we're not necessarily relying on that rate of return because we understand that with those short-term goals, we can't accept the risk that comes with a potentially higher rate of return and reward. So for our short-term investments, we know that the rate of return is likely going to be small because we need to park our money in something that's secure and not volatile, like those online, you know, high interest savings accounts that I talked about, you know, or a CD or, you know, whatever, all of those more safe investments. So that would be examples of primarily cash asset allocation, you know, making sure that it is secure. But this isn't necessarily true for retirement that is 30 plus years away, or really even a kid's college that is 10 plus years away. The amount that you're putting in will hopefully not be a huge percentage of the end amount, and you'll be relying much more on rate of return. And for that higher rate of return, we need to accept some risk, which means incorporating more stocks, incorporating more bonds. And I want to point out that this changes as time goes on, as the time horizon changes, as your risk tolerance changes. It's not like everybody saving for retirement has the same asset allocation. It really depends on what your age is, when you need that money, and it just goes back to just a typical savings goal and analyzing when you're going to need the money, how much you need, that sort of thing. A person saving for retirement at age 25 versus age 60, that asset allocation will look very different, because when you're 25, you can likely invest more in stocks and invest more aggressively and be willing to accept a higher risk for a potentially larger return, because you know that you don't need that money for potentially 40 years. When you're 60, you're really close to retirement, and it may be time to reallocate a little bit and take a little bit more out of stocks and put a little bit more in bonds, just because, like I said, stocks tend to be more volatile. Bonds tend to smooth out the road. So as you're getting closer to retirement, you may not want to actually accept as much risk as, a 90% stock or equities portfolio. So keep in mind that it changes as your time horizon changes. And really all of these things, your asset allocation is something that you should generally be double checking about once a year. Rebalancing your portfolio is what it's called. And we can get into that a little bit later, but having an idea on what that asset allocation is right now and how you will change it throughout the years. I'm not saying that if you're young, you may not change it for a long time, but as different assets in your portfolio grow more, whatever, it can actually, say you start off with a 90% equity portfolio and a 10% bond. If stocks really go up, it could bump you to a 95% stock and 5% bond. And then once a year, you would probably want to sell off some stock. There are various ways to do it, but you want to rebalance your portfolio to make sure that you're actually back to that asset allocation that you previously agreed on. We can talk about the nuances of that later, but I'm just telling you that this is a little bit of an ongoing process periodically, once a year after you get it set. So another thing on stocks is that, more stocks, more volatility. And it's not necessarily a blanket statement that all stocks have the same amount of risk associated with them. You may have seen, and this is one of those things that I never understood, and now I understand it a little bit better, but there are large cap stocks. That would be your S&P 500 benchmark, essentially. These are the large companies that they're going to go up and down a bit, but they tend to be a smidge less volatile, because they are large established companies. Versus a small cap company would be some of the smaller companies that, just because they are starting out potentially, just a little bit newer to the scene, not as established, you would expect slightly more volatility there. And then even that is compared to international stocks, where depending on emerging markets or other developing nations, those could be even more volatile. So it's not that all stocks necessarily have the same volatility, but stocks in general are more volatile than bonds. So going back to your goals and your goals dictating your asset allocation, I think that it's a very powerful way to look at this. I have pulled up a graph on the screen, and this is basically showing an overall trend of the total stock market, the total U.S. stock market benchmark. All right. And you can see that during the time period that we're looking at, it has a general upward trend. Obviously, you can see the large dip around 2008 when the Great Recession started, but there is a general trend line upward when you look at it on this large scale and over many years. So your goals dictate how large of a window you can be looking at. If you have a 10-year horizon, this graph could represent, the returns that you might expect. And you'll see lots of individual ups and downs, but the overall trend is up. As you begin to narrow that window down to a year or two, that's when you can start to see that there are some significant drops in there. And imagine if you were going to invest your money and you were going to need it in 2 years and this, 2008 happened and it plummeted. It obviously did recover, but if you were too aggressive with that money for what your goals were, you would end up losing a lot of money because you wouldn't have you may not have the flexibility to just not use that money. You may still need it, or, it may set back your house down payment plans or whatever. So that's why generally speaking, for those shorter term goals, it's not advised to invest in the stock market, just because you're narrowing down that window and therefore the risk is higher that you could see large decreases. And I think another powerful representation of that is the chart that I have pulled up. And this is from the book, The Boglehead's Guide to Investing, which I'm reading now, and I highly recommend it. Gets more into some of the technical aspects. But this chart is showing the annualized return of large domestic stocks for different time periods from 1935 to 2013. So what they did is they figured out during different time periods what the worst return was and what the best return was. So as you can see, if you're only invested for a year, that is a huge, huge swing of 97% essentially is what that spread is. It could go up 54% or it could go down 43%. And there's no way that you would want to have money that you'd need in a year invested because of how volatile that is. In 5 years, it starts to look better. The best return is a little bit less, but the worst return is a lot less than that. The best return of 29% versus potential losses of negative 12%. And a 10-year, it looks even better. The best return was 20% and the worst return was negative 1%. So that really just shows the general upward trend when you have more time to work with and the volatility of a shorter window. So that's why you can get awesome returns if you have a large window and this goes back to the investing mindset. That you have a mindset that you're not going to freak out and sell when it gets lower. You just have to buy and hold and be in it for the ride. If you personally don't have a risk tolerance that can stomach those big drops, even temporarily in the grand scheme of things, that's where bonds can help smooth out the ride and help you sleep a little bit at night. They can also be helpful for medium-term goals as well as investors nearing retirement, like I talked about. And you may decide that you don't want to be as risky with your investments if you've saved well. If you get to a point where you really don't need the larger returns that you could get with stocks, you could pull back and put more into bonds and rely on a slightly smaller but potentially more consistent rate. So your rate of return depends heavily on asset allocation. More stocks, potentially higher returns over long periods. If you're shooting for a 7% plus rate of return, which is generally what I like to assume, you need to have a healthy amount of stocks in your portfolio. But you have to understand that there's a potential for, a high rate of return coupled with, potential temporary losses, hopefully temporary. And really with all of this, if it sounds like something that you don't want to get into, and asset allocation really determines, the rate of your return and overall how successful you can be when saving for retirement. Just because if you're young and investing in a whole bunch of bonds, it's not going to grow enough, quite honestly. You need to be relying on that higher rate of return and investing aggressively. But there are actually target date funds that do this asset allocating for you, and they can be a really good option. Looking at the Vanguard target date retirement funds, the fees are generally fairly low. I will get into fees later. But you can see kind of what they're invested in, and they recommend, for somebody roughly my age, 30 or so, you're invested in 90% stocks and 10% bonds. So I think that is a fairly reasonable asset allocation. Honestly, for somebody my age, I don't think that I would go personally much more than 15-20% bonds, and that's even fairly heavy. But it really depends on that risk tolerance. And we'll get into how you can determine your risk tolerance. So that risk tolerance, it's tied into that investing mindset. I recommend a buy and hold mentality. Forgetting about it would be awesome. But you really have to figure out, would I sell during a bear market like we had in 2008? And it's hard when you haven't actually gone through it. But that's what I've basically been mentally preparing myself for, is that when it goes down again, and it will, just knowing what I know and staying the course and sticking to what I started and what I planned. I argue that when you're young, you need to learn to stomach the big drops, but you need to be honest with yourself. And if you can't handle the huge swings without selling, you can have that small percentage in bonds, like I was saying, or, forget it exists. That works too. So that's all that I have on asset allocation. It is a really important topic, and it's something that you need to take some time to think through. And it's really personalized for each individual goal that you have with your money. Your asset allocation for saving for kids' college could be different from saving for a wedding or a down payment versus saving for retirement or saving for a big vacation. Any of those big savings goals, you need to determine what your asset allocation is for each and every one of them. And it really depends on that time horizon and how much time you have to potentially make up for volatile markets. So your main action item, and only action item really, is to take some of the quizzes that I've linked. And like I said, you could go through each of these and answer depending on your particular savings goal that you have in mind. I think that works best. Obviously, retirement is a big one. And just kind of go through and see what kind of questions they're asking. I think that can be a really important tool. I also linked to the Market Watch site that shows that general total stock market benchmark that I talked about. And I also linked to Investopedia, which talks a little bit more about asset allocation. Investopedia is one of my favorite sites for looking up a variety of financial topics. They have really approachable articles and a lot of in-depth articles, and they have just a lot of great recommendations on a variety of things. So I recommend looking there if you have any questions on certain topics or as you're doing your own research. That's all I have for asset allocation. Next, we will be talking about how much you should be saving, and then compound interest and fees, like I talked about a little bit here. Then the episodes after that will be financial advisors and talking about active and passive funds, and finally investment vehicles, unless I come up with something else to throw in there. But those are the main ones coming up for the investment series. Feel free to ask me questions. Please pass this along to anybody if you think that they can benefit from it, or some of the other previous episodes. I know a lot of people have gotten benefits out of the budgeting episode and the savings episode, and I'm just so glad to hear it, and I want to keep sharing this information. Thank you so much.